No, you just got to wait a couple minutes, before we really start talking.
Fine. You just ask me any question.
Yeah. I do have some questions.
Whatever you want. I'll try to answer.
Yeah, I got to turn this off. I'm not having this going on.
Let's see. Yeah. I'll mute my phone too. Muted and down.
Okay, we're just going to give it a minute or two, let more people get online, and then we're going to dig right in. And next week we're going to have Dave Dubay and a couple other guys coming in. But this is going to be pretty much how we're going to be doing things. And we also have a couple big announcements about the trader funding stuff that we're going to be holding off on.
This back here.
Okay. Now, the comments. Now, I believe there is an area on the right-hand side of the screen that people from the outside can ask questions. Now, I don't know if we're set up to do that today, but in the future, what we want to do, we want to give you an opportunity to ask questions. That's got to be part of it. But anyways, I want to thank everybody for coming in, obviously. And, I'd say TGIF, but I don't know how good it's going to be. And obviously, with the way the markets are looking right now, they're not looking too good. But, one of the things that I want to talk about real quick, and I'm going to turn it over to Rich. We're in a downtrend. And I said it in my forum back about a week or two ago that, we had 22 weeks up. And there was an occasion, I think, I'm not sure if it was in the Gulf War, where we had, I don't know if it was 22 weeks. Yeah, it was 22 weeks down. But anyways, 22 weeks seems to be like a threshold for the length of a rally or a decline. And I went back in my room back about a week and a half ago, 2 weeks ago, and said, hey, we're, into the 22nd week of the rally. I think we're going to be looking at, 2 to 4 weeks down. Now, Rich is going to be much more prepared to talk about that. And obviously, we know that we're in an election year. But I think the real thing here is trying to figure out, we've had two really, really big rallies, from being lower on the day. And both times those rallies failed. So that's really indicative of a pretty weak tape, I think. And the other part about it is that one of the people in my room asked me about, I love trading the gaps in the S&P, and I know Rich has got a great study. I didn't follow him yesterday. I don't even know why I could shoot him. But I love trading the gaps. I think the gaps are, if you catch a gap right, it can make your whole day within minutes or a couple hours. And those gaps, especially when you're in a downtrend and you open higher and you're in a downtrend after those are opportunities that are generally pretty good for NASDAQ's going back down again. Those are pretty good trade opportunities. And I think if you are trading the S&P futures or whatever you're trading, really, even options, you see a big gap up and you don't think the market's good and we're in a downtrend, put an option spread on, if you don't trade the futures. But again, I think there's a big thing here in deciphering between what is a real rally and what is a dead cat bounce. And that's not always easy. The other thing is, we've all known, that Iran was going to retaliate at some point. And obviously some of those headlines hit the tape overnight, and then they kind of picked up this morning. And that's when the selling, really early morning selling, started to accelerate. You're on a Friday and there's an options expiration. So there's going to probably be a lot of two-way flow, even though we're going down. But this could be a pretty big turning point. And as I've always said, and I've gone out on live streams on Twitter many, many times, and I've talked about where I thought the first war would be that the United States gets in. And I've always thought it'll be in the Middle East. Now, I hope that that's not the case. But when you've got this much geopolitical stuff going on and none of it is really good, something's going to happen. And this morning, Jamie Dimon came out after their earnings, and I think a lot of people know this. I posted it very early in the morning. Basically, he said that, he talked about the geopolitical situation being pretty dire, and then he went in and talked about QE. Now, we all know that you can't rack up debt the way we've been racking up debt. It just doesn't work that way. Quantitative easing can work, but while it's working, and then it starts to get better, you're supposed to pay back that debt, and that's not happening. They're doing more repos, and the thing is that it's going to be a big quagmire. And then the last thing I just want to say, and I posted this on Twitter too. As you know, I've been friends and a confidant of the Pitbull, Marty Schwartz, for a long time, and Rich has gotten to know him too. And, one of the things I really, really respect about Marty is that he knows he's outgunned in the S&P futures. He says it all the time, that all the stuff that he used to use doesn't work anymore. He does have something called the dots, and the dots tend to line up pretty well on big moves. Back about a week and a half ago, he went in our room and told people he was buying GLD and buying gold futures. And I don't even know where gold is. I know that it was up $50 this morning. I know that silver was up $1.50. All this stuff is inflationary. It's also a risk on, risk off stuff, but I was really, really, really prominent on Twitter and on my live streams. And this was back right after the Fed started talking about lowering rates toward, December or November, that there was no way that in the world that they were going to be able to lower rates. And I know that one of the Fed governors came out and said that he thinks that there could be one, rate hike this year. I'm in a different camp completely. If the inflation keeps heating up the way it's heating up, the next step, and I know that everybody would say boo to this, especially during an election year, I think they're going to raise rates before they lower rates. And any kind of stepping out of that, I think is going to be a major problem. Rich, we talked about yesterday about, you said that despite all the weakness that we're seeing, that it's an election year and you still thought that the markets would recover. Can you talk about that?
Yeah, I do agree. There's a possibility with inflation that things may be different this year, but being an election year, I think the Fed's under probably a lot of pressure not to raise rates. But I just look at my studies, and my studies overall, forgetting about the fact that it's an election year, I went back. Let me jump on this one study I have here, and I'll kind of show you what I'm looking at real quickly. First, this is conditional formatting, which we're going to look at something there in a second. But back here, here's the returns. This is the returns since 1970. Here's every year of returns, and this column here has the up year returns, and this column here has the down years. But since 1970, you can see if you look through here, there's never been a singular year up. They've always come in pairs or greater. So you can look back through here and see that. That's never happened in 54 years. Last year was an up year. Based on that, because there's never been, I don't know, I'm just looking at the stats. From a statistical standpoint, there's never been a singular up year. Not that it can't happen. I don't think it's going to happen this year. The other thing that has happened this year is we've had December was up, November was up, December was up, and January, February, and March have all been up months. But just looking at the January alone has been up 31 times and down whatever the difference is between that and 54. But and then February was up and March was up. So just look at these real quick. So that's happened 15 times where the first 3 months of the quarter were up. And when that's happened, There have been down months, but when that has happened, when the first 3 months of the first quarter have been up, we've never had a down year ever. And I don't think this year is going to be any different. We've had months that dipped lower on the year a couple of times, and I don't even think that's going to happen this year. So forgetting about that it's an election year, forgetting about everything else, just looking at the market from the standpoint of the first 3 months are up, and in 54 years that's happened 15 times. The market's never been down. If you even look at just January being the barometer, everybody's heard of the January barometer, I think. Let's clear this out and clear this March out. I mean, even looking at January where it's up 31 times, when January's up, in 54 years, when January's up, the years only ended up down 4 times. So it's a really good indicator. It really is, and that's looking at the whole month. And not only so based on just looking at that, forgetting about everything else, forgetting about interest rates, forgetting about political events. January being up is very positive, and the first 3 months being up is exceedingly positive. We've never had a down year when that's happened, and I don't think this is going to be any different this year for whatever reasons. I mean, in this program here, I can look at the political years here. I've put in midterm elections and who controlled the House and the Senate together, and I've got all kinds of political mixtures in here. But here's the presidential election years since 1970. When January's up, that's seven times that January's up since 1970 that we've had political election years. There's never been a down year when January's up and it's an election year. It's never been down. I don't think this is going to be any different either, regardless of what the outcome of the election is. I'm no comment on either political candidate. It'll be whatever it's going to be. But looking at it in any sense of looking at it that way, I think this year is going to be up regardless of what else takes place. Even if interest rates inch up a little bit to stem inflation, or they don't go down anymore. The market's been rising with interest rates being held here this year when I thought they would be going down initially. Now I don't. Now I think rates are going back up over the next 3 or 4 weeks. I don't think there's a prayer. They may go down a little bit over a little bit for the next week or so. There's a potential to go down a little bit, but I think they're headed higher over the next month. So I'm working on a study to see how big of a pullback you can expect. I mean, I've estimated that we can go down 3 or 4%, and which would basically be half the gain. We're up 10% or so. I'd have to look up the exact number, but we're up around 10% in the SPU and the NASDAQ. And if we cut that in half on a pullback, which is I think about all we're going to be able to pull back anytime this year, it's not going to go negative on the year. I really still hold to that. We will have a pullback where we'll pull back half the distance, maybe. I've been working on a study that I've almost got completed, and I'll have a real good idea about what the potential pullback is going to be. By the end of the weekend. It takes a lot of coding to do to do that study. In fact, I think I've written like 500 lines of code in the last 3 days just to do this study. So because it takes a lot. Anyway, I'm not looking for the year to go negative. It could pull back maybe half of the distance of what we're up. And I think we're in that period right now. In the second quarter, which we're in the second quarter now, April has been, over the last 54 years, April has been the best month of the second quarter. So yeah. April, May, and June, April is always the best month. So, if this month's down a little bit, and I think I originally gave it about a 30% probability of being down, and obviously 70% being up. I June or July, one of those 2 months is definitely going to be a down month. I don't know which one yet, but one of those 2 months will definitely be a down month. And July typically is the best month of the third quarter. And September is obviously the worst month of the year always.
Well, didn't we rally last year toward the end of July and go
Well,
up?
July was a monster month last year.
Yeah.
July was well, I have it right here. Might as well go look at that. Let me clear this out. July last year was, go here to the end. Uh, 2023. In 23, July was up 3.11% last year, 138 points. Actually, the year before, 2022, which was a down year,
Yep.
July was up 9.11%. The average over the past 54 years in up years, July's averaged up 4.1%.
Wow.
Down years down minus 2.69%, and overall it has averaged. I don't have the. Did I put that out there? Yeah, 6.19%. No, what is that? Oh, that's the range. Sorry, I'm a little far away. I don't have the overall percentage there. I just look at up years and down years, and anyway, but you can see that. In the last 54 years, July's been up 29 times and down 25. But when it's down, it's not down much. We had, there's been a couple of years where it's bad. 2002, that was towards the end of the .com bubble, and 96, it was down a little bit. But and then way back in the earlier years, it was down some. But even during the financial crisis, 08, 09, here's 08, 09, July was up. I mean, July tends to be a great month.
Yeah.
So, and although this year I have it pegged as, because of what's going on, the way my model is working, it says that June or July is probably going to be one of those 2 months is going to be down. And I give this month a small probability of being down, but looking at the way the market's trading right now, and it's been exceedingly resilient. It surprised me, but a couple of days ago when we rallied back, I thought it seemed like it was a little weaker, and then yesterday it rallied back, and I really actually couldn't believe it. So I'm not surprised that it's down today, and I'm looking for this market to go lower at some point in time over the next week. And my target right now, if the ES can get down below today's low and below this 2SD level, which is 51.72, I think it'll take out this 50.41, and my target's lower than that. It's down quite a bit lower, actually. Not a lot, but remember, it's not going negative on the year. I do not think that's happening. NASDAQ, same thing, been exceedingly resilient. And right in here, if this NASDAQ takes out this low, I think we're headed down here pretty quickly. 17,626. That's what I have it pegged at. And Danny, you were talking about my gap studies this morning.
Yeah.
This morning, this is the gap study from this morning. This morning, the NASDAQ, there's not a lot of instances. It was down quite a bit, and it showed it only had a 23% probability of going back up and filling the gap, and only a 15% probability of even making it back down or to the prior high, but it had an 84% probability of going to the prior low, which it already did.
Right.
And the ES was the same way, 11% probability filling the gap and going to the prior high, and a 77% probability of taking out, going back down to the prior low from where we opened. So I I said in the room, I gave a tight stop trade for the ES, which actually got stopped out. So I hope that people got back in. I mean, I will put those out, but my preferred trade was just to sell call spreads, and that's what I said. I think in my stuff here.
Yeah.
Sorry.
Now, Rich, when you come in the morning and you do your morning update, can you tell everybody a little bit about what you go over?
Well, I go over all my charts. I go over the Nasdaq chart. I have a few Nasdaq charts, a few S&P charts, and I do Ichimoku for like kind of a real look at. I like the cloud. I've been following Ichimoku for like almost 20 years, so I can look at an Ichimoku chart and I just look at the structure of it, and there's a lot of things that I look at, and I've invented a couple of even indicators on the Ichimoku chart that I look at, and as I say, I can look at the interplay between what's going on, and it gives me a pretty good idea about. We'll look at my Ichimoku charts right here, and I also have a time fractal theory about market behavior, and it all fits in right here. This is the bonds, and I'm looking for the bonds to go down here. This is my longer term Ichimoku chart in the bonds, and we're trading below the cloud. This is bearish, and below here it's going down to here, and I don't.
What price is that?
It's right around 112.23 ish.
Well, you said 3 weeks ago that they were going to go down.
Well, yeah, because actually I put this on my chart to be very precise. This draw came on my chart back on 2714, 2614. I put this draw on. So I've been expecting this from the 6th of February. I mean, it came down here and bounced off my level and went back up, but it didn't. Nothing changed. It just went up here to where the cloud had already formed and turned bearish, right. And it kind of came back up here in the cloud. I thought we had one shot at like regaining the cloud here, and it didn't do that. And now this cloud is sloping down. Everything's negative here.
Rich, what is a cloud?
First of all the Ichimoku system is moving averages, but they're not normal moving averages because it's the moving average between, for basically the cloud. There's some different things that go on in the cloud formation. They're displaced moving averages, and then they're moving averages of moving averages. But for all practical purposes, you're looking at a 9, a 26, and a 52-day moving average, but the average is the midpoint of the highest high and the highest low in that time period. So it's kind of different, and there's just a lot to know and a lot to think about what's going on, and all the elements have to be above or below the cloud to make it bullish or bearish. Currently, with this is a bearish cloud. This is a bullish cloud, and currently, below here you can see the market, and this is displaced. So this is out here. So this cloud was already formed by the time this got here. The price went up to and hit the cloud and failed. Walked right down, then tried to go through there again and failed. And now, I mean, not to say we didn't have a rally back up, but the overall trend here is down, and it's steepening, so I don't see how we can do anything but go down lower here in the bonds, and the notes are pretty much the same way.
Yeah, they feel that way.
Now, to get back, here's the notes, and this looks like it's going down to 107 right here. That's what I'm thinking, and now the ES and the NQ are a little different. This has been a tremendously strong rally. I don't know. You can't go back far enough to figure this out. In order for now, my shorter term Ichimoku chart is definitely bearish, but in order for this to go bearish, this market would literally right now to turn completely bearish. The NASDAQ would have to go at this point in time completely below 17,200. I mean, and I don't think that's going to happen. That's 1,000. It would have to break 1,000 points to turn this bearish. That's not going to happen. This can come down in the cloud here, even if this price comes down in the cloud here. 17. We're talking right now 17,690, so 17,700, and I'm thinking it could dip. What did I say? 17. I can't remember what I said. It's somewhere close to here, but it'll have plenty of time to turn around. And there's a lot. That's why I'm not looking for like a big break, but I still think we're going to dip down in here, and it's kind of. I don't see how the market can stay up if bonds and notes dip the way I think they're going to dip. And we won't know. The other good thing about the cloud that you can see, it's all about being able to used to looking at it over a long period of time. And here we are back at the bonds right now. In order for this to turn and go back up, I mean this cloud's real thin here. So if it stays thin and we break down here, it's still going to be. This is like a month and a half or 2 months out. By the time this formation would be done. And I think it will be at least a month. It's going to be at least a month and a half at this point in time before we even have a chance of, having this form here that we can break back out above the clouds. So that's why I say over the next, 2 or 3 weeks, I think this is still headed lower and this is headed lower. And maybe in a month and a half, which, maybe sometime in the third quarter this summer, rates may, it may turn around, but I don't see this turning around here. Even if it moves sideways, it's still going to be a month and a half before this can get back above the cloud. I mean, unless there's a really phenomenal rally, and I don't see that either. So we're going to have to, the market's going to have to move over here day wise to get to at least here before it can break back up. That's a month away.
I'll click on comments on the hey, can you click on comments on the right hand side? We've got some people from YouTube asking questions.
Right hand side.
There you go. Hey Rich, what software he's asking?
Oh, I use Excel. It's Microsoft Excel. That's what I do all my coding in. So all my coding's in I use VBA. I do VBA and Excel. And a lot of people ask me why I don't do Python. First of all, I've been coding for 5 years now. I started when I was 60. So don't let anybody tell you can't, do it younger. And if you're younger than me, there is absolutely no reason everybody should learn to do a little bit of this. I really believe that because you can put stats on so many things so easily done. You just got to work at it. And
well, Rich, we've been talking very seriously about offering like a coding class, right?
Yeah, and we have been talking seriously about that. And if I do it, I would do it with I would want to do it with somebody that's got a little bit of, if they're interested in Excel and VBA, have a little bit of experience in there. I can. And then it would be very limited because I've never done it before, and I would want to make sure that people had some basic understanding because I'm like in this. I'm not just saying that. In the last 5 years, I work 80 to 100 hours a week. I've spent at least 15,000 hours in the last 5 years coding, and so I know what I'm doing, and I've talked to people that are really have degrees in software engineering, and they tell me I'm good. This is just to kind of give you a little idea about what I do. I got stuff on the cloud there, but here's my.
Here, hold on 1 second. Sam's asking, where do you? I think he's seeing. Where do you?
Do my daily review?
Yeah.
I do my daily review in the room on Danny's platform. So anybody who's a member of subscribes and is a member, gets access to my room, and I do it every morning between like 9 and 9:30. I review my charts. Yeah, Danny's got a thing up. We have a real limited offer. There's not that many spots left. So if you're interested, grab them, because I agreed to what's it's a really low price for what goes on, because besides access to my room, you have access to all my materials. Like I have probably 30 or 40 hours worth of videos that you can watch. I have hundreds of pages of downloads. I have a gap course with tons of statistics. I've just redone all the statistics. I thought I was going to redo all the material, but now I think I'm just going to add the statistics in, the new statistics updated with some other additions to them.
Well, you're refining your top studies right now, right?
I'm refining, and I've redone a lot of my studies. I'm redoing all this stuff all the time, and not only do I redo them, I add to everything every time I redo it. Like this study that I'm working on now, I just showed you. That's my conditional formatting study, but I have like where's this? I gotta in this file. See, like every file, you open all the files. I have saved old studies, and these are all new studies. And some of them, that's a rolling. I don't want to do that one. Annual quarter. Here's a quarterly. This is one of my favorite studies, to look at things on a quarterly basis. And I have all the stats on all the quarters going back to 1970, and then in here, when I review things, I can look at individual quarters, and like here I said, what's the top 10 quarters by points, or what's the top 10 quarters by percentage, and I have other filters that I can look at other things, like how many quarters were single quarters in a row, up or down, or consecutive up or down in whatever time period I want to do. And let's see, let's go here and do all. And like this kind of coding here, when you start doing filters off the side with these drop-down menus, it's a little more sophisticated to do that than it is to use the drop-down menus up here. But I dump all this stuff into tables, so I just immediately have all these kind of stats that I can look at.
Right.
And it really is helpful.
Hey, Rich, let's see if we can get some people to ask some questions.
Okay, sure.
I know Sam Hay he's got the link to the room, the deal. But is there anybody out there that would like to ask a couple questions? We'd like to answer those questions. I mean, I think it's better to. And if you go to the right hand of the screen, there is a comment section, and you can click onto it. But in the interim, Rich, so you're thinking we're going down this afternoon, right?
Yep. I said this morning, sell call spreads. I actually bought some SQQQ puts for next Friday's expiration. I don't normally step out that far, but I think that the NASDAQ's going to drop 500 points from where it was this morning. My level is quite a bit lower, and the puts that I happened to pick up this morning, they doubled, and then they just went. They were still up even on that pullback, but now they're back up to double from what I paid for them this morning. Depending upon what goes on, I may dump them this afternoon, or I may hold them till Monday, because there's a lot of theta in those things. Right.
Now, one thing we've been talking about, and you would only I mean, there's a lot of suspicious stuff on the internet, right? I mean, and especially in Twitter.
I want to correct one thing. I think I just said I bought SQQ puts. I actually bought SQQQ calls, because I'm trading the inverse product, the inverse QQQ product. Anyway, so that was calls, not puts. I don't want anybody to be confused there. I'm thinking down, and you always think puts when you're thinking down, but when you're doing an inverse, you're buying calls, not puts. Okay, go ahead, Danny.
But anyways, I think I mean, there's a lot of people in your forum that know this too. I mean, they see it every day and they listen to you. You come on the mic and you're talking and you go offline, you come back on. You're really good about that. And a lot of people that run these types of forums, they don't, if there's a guy that's in there all day long and he's calling the shots, that's pretty tough. But with you, because you're backed by so much statistical stuff, and we've watched this, and I've watched this, and we've talked about this many times. I think that the migration over to the new format that you did really, really, really improved what was already very good, your daily calls. Now, let's just back up a couple. And I know that if you were not in his room, you wouldn't know this, but there was a couple of days ago where you bought a put spread, and what was you paid, like you sold it at 20? What was that put spread?
Danny, unless you remember the specific day, I this week I think I've been pretty correct with my early morning calls every day, and which is I'm pretty consistently really good in the morning. I mean, if you find a place that you're good at trading, let me go back here. And I'm looking over Danny on this monitor over here. If you find a time of day or a day of the week that you're really good at, you need to stick to it. And if you find a time where you're not as good, you need to avoid that. But between the gap study and all my levels are color coded. These are time fractal color coded levels, along with some Fibonacci levels that I pick out, and a couple of, and then of course my standard deviation levels. And when I look at those levels and I look at like my gap study this morning said we were lower, but we were still above yesterday's lows. And the study clearly said that, there was a good probability we would go to the prior day's lows. And when I looked at where my levels were, it seemed to make sense that we would do so. And in the NASDAQ in particular, I mean, I think we opened up here about the one standard deviation. Well, I had no support anywhere between this one standard deviation level and this two standard deviation level. And so far, what did we do? We came down here. This level here is the low is 18,151. Well, my standard deviation level is 18,150.92. I mean, I do that all the time.
Yeah.
Yesterday, the initial break on that number of 300 points, was it? Yes, I guess it was yesterday. Yesterday, the day before yesterday. Oh, I think it was the day before yesterday. And that standard deviation level is gone anyway. But it hit it came within, after a 308 point down move, it missed my two standard deviation level by like 1.3 points. I mean, and you can see here that last night they hung around the settle but stayed below this purple level and traded down, and this was kind of negative overnight. And then right here on the 9 o'clock we closed below this 1 SD level. They kind of popped up again above that, and then they came back down below it. Well, once they start below this stuff, if I don't have any levels in between there, usually they go to my next level. That's just the way this whole thing works. And right. I mean, I've looked at so many different things over the years. I've tried Stottlemyre, market profile, all kinds of other trading systems. And you can see I don't put trend lines on my chart. It's all levels. It's all about levels. And the standard deviation levels are based on implied volatility and the settlement price. And that's what the options pricing model uses. So anybody who's not aware of standard deviation levels is absolutely doing themselves a big
we're hitting new lows. You see
well, remember what I said this morning. If we take out this low, it's going to this third standard deviation level, and this is my target area down here anyway. I have a short, close target right here, but this is my target area here for the NASDAQ. And the NASDAQ is, it's bounced off here a few times now, and I think if they get down here again, especially on a Friday, it's not going to be good. And the ES is already chopping through, making new lows on the week. They have this level. This right here, this 51.4107 is my initial target. And if they close below here, I have an absolute lower target that they're going to. You don't see it here, and I'm not going to tell you right now, but I can just tell you if on a Friday close below that 51.4107, excuse me, 07, I can barely read it. They're definitely going lower. That's just the way my numbers work. And you can see like throughout here, these my numbers are pretty good. I think they're pretty good, and
let's talk about the numbers. Can people subscribe to the numbers if they just wanted the numbers?
Well, they can get my standard deviation levels and my percent numbers, but these fractal numbers I haven't programmed into the.
No. I'm saying, but don't you put out daily levels?
I put out daily levels. I do. I put out 7 sheets of data every day. In fact, here I'll just go through here. I'll just grab this real quick.
Now you're starting to cover crypto.
I'm working on that. Hopefully I'll have that done in 2 or 3 weeks. Everything I have to build some databases for it, but I'm planning on. I don't have bonds or notes per se. Let's go here and grab this 1 second real quick.
But are you going to do bonds and notes or no?
Yeah, I'm doing bonds and notes. I'm adding cryptos, bonds and notes. And here's my merged PDF. Let me put this down and get this. So this is like I have made this I call it my pro pivot sheet. I've made a version of this sheet for 25 years. Even when I was still on the floor, I used to print this out, and it didn't look the same. It's gone through various changes, but here's the open, high, low, close, and that's the 4 o'clock close. I use the 4:15 close. Not going to get into why I use that. There's the daily change. There's the fair value.
The old S&P 500 close and the Merck.
I used the old 4:15. Yeah, it used to be 3:15. Chicago 4:15 in New York. That's the close that I use. A lot of reasons why I use it. I'll go into that sometime if you ever come into the room. And then I have 1 and 2 standard deviation levels, and my standard deviation levels are based on my 4:15 settlement prices. They are not based on 4 o'clock settlement prices. That's why people can do the same thing, and I tweak my implied volatility a little bit. And then, of course, these are the cash numbers: 52-week high, 52-week low, and then there's a few years of old closes back there in case you're going down, that you can see what's going on. Last month, 24. I keep track of all that stuff, so you know where you are during the week. That's just this sheet here, and as I say, I've printed this out one form or another for the past 25 years. Here, let's see.
Now, Rich, you were a trader in the S&P 500 pit, and some people don't know who you are. But I remember you from the floor. You used to stand over in front of the pulpit, right?
Well, and I actually was in the S&P 500 options pit, which your desk was down on the. I remember that was the.
You were in the futures for a while, right?
I was in the futures for a while, but then I moved to the NASDAQ pit. Here's this one is the one I wanted right there. I'll look at this in a minute. Then I moved to the NASDAQ pit, but I had a little. I started out. First of all, I used to do out trades on the floor, and then I was on an ARB phone for a while, and then I started trading. And when I first started trading, I traded cattle options, because it took the smallest amount of capital and the least amount of risk at the time. And then I joined a very small group and was trading S&P options. I think I traded in there from like 1990 to 95. And if you remember back in the 90s, oh my God, the market was so slow. It
Oh,
just got ridiculously slow. I mean, we had months back in the 90s. Let me look at the SPX here and I'll show you. That should be a $ SPX.
but right now you're an option trader. You don't really trade a lot of futures anymore, right?
No, I strictly stay with options now for one reason. With options, I never trade any options naked short ever, never. It's either an option spread or a long option itself, because then you know what your risk is when you put the trade on. It's defined. If you're long a put or a call, the most you can lose is whatever you paid for the premium. If you're short premium in a spread, the most you sell a $20 spread for $12, the most you can lose is $8. The most you can make is 12. So there's limited risk and limited return. And
But if you buy naked puts like Marty used to do.
Well, if you buy naked puts, there's still, it's limited risk, unlimited return. The worst possible position, and even if you're trading futures, and you're long, you have unlimited gain potential and unlimited loss potential. It's unlimited, unlimited. With options trading, if you're long a put or a call, it doesn't matter. You have limited downside and unlimited upside to whatever you're doing. And with spreads, it's limited and limited. But if you sell options like sell puts or sell calls naked, premium seller, and you have nothing against them, no hedge against them, you have limited gain potential and unlimited loss potential. It's the only one where it's limited gain and unlimited loss. Everything else is unlimited, unlimited, or limited, limited, or limited and unlimited. But so that's the absolute worst possible combination you can have.
Yeah.
And over time, if you sell premium, you will give back. You can make money for 10 years.
Yeah. Well, there's an old story that you make, and then you blow up.
Exactly. And I think it was even in Nassim Taleb's book, the Black Swan or Fooled by Randomness. I think he had the same story in both those. And by the way, I love that book. But he talks about an options trader that made a lot of money.
Niederhofer.
Well, Niederhofer did that too. Oh my God, I was in the S&P.
He took down Refco doing that.
He took down Refco, and I remember when he used to do that. He used to sell these teeny puts that were, $100 out of the money, saying that they'll never come in, and he'd come in and sell like 10,000 of them. And
they sell dimes, nickels, 20 cent, 30 cent, 50 cent.
And then one time the market went down, and that is the loss that Refco had on its books. That when they went public,
they lied about.
They had it covered up, and that drove them out of business. So anyway, that's why I don't. I say if you're gonna be naked short, you could on a limited basis do it on calls, but you can never do it on the put side ever. No. And there's a reason for that on the put side. Let's see if I go back to.
I mean, we had customers at the desk that went through the desk for years, and that's all they did. They sold premium, and every 3, 4, 5 months, they'd make, and then they'd get these margin calls, and they get wiped out. And it's never pretty when that happens. I mean, when you get these big spikes, you get these gigantic margin calls that can't be met. And then the clearing firm has they have no choice but to liquidate you, so.
Right. Absolutely. They have no choice. I'm trying to see if I can go back. Here's here's 93, 94. I should do this on a monthly chart. But we back here in like somewhere back here in the early 90s. I mean,
Yeah, 92, 93.
we had 1 month back in there. I guess I should be looking at a monthly chart. We had some weeks where the market stayed within like 2 or 3 points for the entire week. It was just, let's see, what is this?
Well, those are that's a great setup for a premium seller.
It's a great, well, it is and it isn't, because volatility drops to real low prices too. So it's not actually the best premium. Like here's the month of July back in 1993. It looks like the high of the month was 451.15, and the low of the month was 441.42. So I mean, it was a $10 range for the month. It's hard to trade that.
Yeah.
Anyway,
well, listen, Rich, let's do this.
But the reason I was bringing that up, Danny, is because you were talking about where I was. I actually went to work for Globex Marketing. I was trading electronically. I knew the guy who was running the marketing department, and so I went and taught people how to use the electronic trading platform. And I got really, good at learning some of the nuances of the platform itself. And I went back in and started trading again. And, I was trading the NASDAQ in the pit in the morning when I went back to trading, which was a great trade anyway. And then they started out with the E-mini. And I was one of the first 10 traders with a terminal on the floor trading E-minis. And, I long story short, I did really well for a lot of years there, and then moved to Colorado and stayed with the screen. And then things changed, and that's when I got interested in the coding and knowing that I had to do something different. And
here, look what Howard. Look at the question Howard did in the comments section.
Let's see if I can see. Let's see. I'm not sure that I can see this comment.
Well, okay, if you click on comments, but it's Howard Reinglass. He was a broker in the S&P pit that I used to use, and he's friends with Rich. And he said that he thinks I should write a book about my life on the CME. I appreciate that, but I got to tell you, after all those years of fighting all those people down there, I'd have to really do a lot of aliases. But I appreciate that. Look, let's tie this up, Rich. There's a lot of the markets are moving all over today, and I think we've covered a lot of ground. But again, we're going to be continuing to do this. And again, if you're interested in, and I'm going to tell you honestly, I make and I lose. I make and I lose. Sometimes I do good. Sometimes I do bad. But I'm not kidding. Out of all the people I've seen, and we have David Dubay, and he's very good too. He's a Wall Streeter. He's got systems he wrote. He's just a great guy. But, one of the things that I've noticed about Rich, as I've been saying, is his calls are getting better and better. And one of the things that I like about Rich is I like talking to him at night. In the morning, if I'm a little busy, I miss his morning update. I came in late yesterday. That's part of why I wasn't listening about the gap stuff. But I really think that if you have your own stuff that you use and you're looking for like validation, really, seriously, the stats are the stats. And one of the things about Rich, I don't think he puts a lot of his own opinion in. I think that the stats are his opinion. And I like that. You know what I mean? I could say, hey guys, I think like I did yesterday at the lows of the day, I went in, I had been buying early and I was losing money. And then I went in and I said, there wasn't a bull within 10,000 miles. And the S&P was going to go back up to 5230. I doubt anybody even thought for a minute that it was going to go to 5230. But I will say one thing. Rich has made unbelievable calls. And the only reason I was asking about the futures versus the options is a lot of guys don't trade futures anymore. They'd rather key off of, levels in our trading room, guys that do trade well, or trade off of some of the stuff that you're doing, Rich, because you're really, really doing well. And I think that this is really just the tip of the iceberg for you. I really do.
Well, thank you, Danny. And just to add, I'm becoming more dependent on my statistics, and I'm in the process right now of I have 4 algorithms, and I think my goal is to have all 4 of them live in my room by the end of this second quarter.
Nice.
For sure, I'll have 1 or 2 of them going, and when these algorithms go, it's there's no opinion to it. I mean, it just kicks out what the probabilities are, just like my gap stats. It will kick out the probability of being long or short is at any given time. And they will have, trade trigger prices. But when I get that all done, the people who are in the room at the time are going to benefit with whatever they're in at. But when I get these completely done, and I'm never going to be completely done because I always add stuff to them. But the really big algorithm that I want, and I have a couple of people in my room that are really after me, but I have already 30 million bits of data downloaded to run on this algorithm. And it's a monumentous task to get it all put together. And I had to change the way I was coding to do it. I'm not going to get into the coding aspects of it. But I literally, since last November, I've rewritten 17,000 lines of code besides all the new code that I've written. I had to rewrite a bunch of code to make these other programs run well. And it's a
labor of love.
It's a labor of love.
Listen, let's tie this up, Rich. The markets are moving. I'm sure we need to get back where we are in our own forums. I want to thank you. I want to thank everybody for coming in today. I hope that you guys, you got the link for Rich's room, and I would suggest that you really do this. And I mean, there's a deal that we're offering is $900 for the quarter for my room, access to my room and Rich's room. Yeah. Well, we'll think about that. But anyways, it's a great deal. And well, let me finish. I would bet that within the first day or the first few days, you will at least make the $900 that you invested for the quarter. Would you not say that that's a fair assessment?
I don't like to go there, but the thing I want everybody to understand, that's a very limited offer. I mean, once the slots that I said we are going to do are done, the price is going up. I'm not going to do that price for very long. And for sure, when I finish these other algorithms, I mean,
that's when things go skyrocketing.
Yeah, I mean, it might be that much for one algorithm for the month,
right?
Because
now, if people lock in now, they're in for good, right?
No.
Okay.
The people that have been with me right now, they're locked in. I will obviously I'm not going to raise prices on people that come in now right away, but it's not like a guarantee that you're going to lock that in because.
But you're not going to, if they sign up, you're not going to. I'm not going
to do it right away, and it depends on how much I can get done and when I can get it done. But I put in thousands of hours into doing what I'm doing, and there's traders that you can make that much off of one trade for what you pay for a quarter.
Yeah.
And it's not a lock-in guarantee for any period of time. I might do it for
right.
Okay.
All right, listen, Rich, let's cut it off. The markets are going. We're still on the lows in the S&P.
And they're going back, right? Pardon me.
Be
we'll be back.
Okay. Have a good weekend, everybody.
You know, Danny, one of these days, possibly next week, if I can get enough stuff done, we can do one where I go do like my opening routine. So we
Yeah.
can do like a 9 to 9:30, 9 to like quarter to 10, and I'll show them how I walk through the first hour.
And I'll tell you what, that if you're in on that, you will get a great feel for the direction of these markets. And I'll tell you what, you've helped me immensely. You know, I'm always a bull guy, but when you said, I think it was in November of last year, or late October, you said that the S&P was going to go to 50.
My first objective was 5,100 by February.
Yeah.
I said that absolutely. I said that the end of October. I said we're going to 5,100 by the end of February. I think I have an objective right now for upside. You know, I think the low for the year is in, regardless of what happens. I'm still very, very bullish, but right in here, I think we got a little pullback coming. And you know, another thing, Danny, because I have a couple people, you know, that follow me that like to sell, and they have literally said, you know, sometimes it's not the trades that you take, it's the trades you don't take. And, you know,
100%.
They will do the trade when they agree with what, you know, I'm looking at, but they won't go against me when they don't agree with me.
Right. So you save them money because they didn't fade you.
Exactly. Exactly. And, you know, I have, excuse me. I'm not always right, but I have some pretty good trades.
Yep.
A lot of times, and I have well, we're working on it.
Yeah. All right. So let's call it a day here, and I'll see you in the room in a couple minutes.
Okay. Thanks, guys.
Thanks. Take care, everybody.
Oh.